Hello, everyone. Welcome to a Wall Street from Main Street podcast. My name is Mo Daoud, and today's guest is a returning guest. He is Rick Rule. He is the President and Chief Executive Officer of Sprott U.S. Holding. Rick, happy holidays. Thank you for joining me again.
Thanks, Mo. It's always a pleasure.
Rick, for this podcast, I want to do a 2015 review and get your outlook for 2016. Now, you don't have to give me any prediction on where you think the market is heading number-wise or where the commodity is headed number-wise in terms of prices, because I think that's a useless exercise, because no one really knows which way the commodity price is going to go and how much. So I want to start off by talking about 2015 and reviewing it. And let's start by talking about the commodity market, which has been pretty much on a fire sale this year in terms of being undervalued and discounted, starting with oil, gold, silver, and a lot of the other commodities. So I want to get your thoughts on 2015 in the commodity market. What's your thoughts and insight on that?
Well, the commodities space went from bad to worse, confounding many so-called experts, myself, of course, included. The most dramatic part, I think, of 2015, perhaps the most illustrative part of 2015, was the fact that despite reasonably good equities and real estate markets in the United States, the underlying economy on a global basis showed an absence of demand for anything. I haven't seen a geosynchronous slowdown like this really since the middle of the decade of the 1980s. And I have to say, I was taken by surprise. My own inclination had been that the global economic slowdown had sort of reached its nadir at the beginning of the year, and that low commodity prices, as a consequence of the utility afforded to consumers by low commodity prices, would begin to see some demand. But the truth is that that was very wrong. In the absence of a demand-led recovery in commodities and commodities equities, you're left to a different way for a recovery, which is through supply destruction. That's a very messy process, as 2015 has shown. And unfortunately, my supposition is in energy markets and in industrial materials markets, base metals and non-ferrous metals and coal, that probably 2016 will not be that much dissimilar to 2015, although the bottoming process may be in rather than a continuing of the decline.
Yeah, and for the oil market, I think, or commodity market in general, I think what hurt it the most is that the China economy has slowed down in 2015. Over the summer, we saw their stock market crash pretty much overnight, and they saw a double-digit drop in most of their stock exchange. So I think you're right. The supply destruction, I think, mainly came from China because they're the one that buying all the base metal and the precious metal and the oil.
Well, certainly the Chinese have been responsible for much of the increase in demand, and as their economy grows, of course, they're responsible for baseload demand too. What has been troubling, I think, is the lack of any demand from big, established, mature markets. By that, I'm thinking the EEC, Japan, Korea, Taiwan, and of course, North America. By North America now, I mean Mexico, the United States, and Canada, the NAFTA countries. The truth is that all of us blame China, but none of the rest of the world seem to be able to pick up the pace either. I'm particularly distressed, I guess, about U.S. growth because it's the country I live in, despite the fact that equities prices have been good and auto sales have been good, at least relevant to the recent past. The truth is that the economic malaise in the United States that we see, that is the lack of demand, is troubling, equities markets notwithstanding. And although everybody writes off the United States in favor of more fashionable markets like China, the United States is still home to 26% of the investable assets in the world and 24% of global demand. And so the slowdown that we saw around the world, I think, was at least of equal importance to the slowdown that we saw in China.
And the oil prices this year have been stayed pretty low for the most part. Right now, the oil prices for Brent is at $36, and yesterday it was at 35.98. Excuse me. So the oil prices have stayed low for the most part, and I think a lot of people were predicting a V-shaped recovery for the oil prices, but that hasn't happened, and it looked like it's going to continue on and onto 2016. I mean, for the oil prices, a lot of the government around the world rely on oil revenue to fund their social programs, especially big oil countries like Saudi Arabia, which is projected to go bankrupt in 5 years if the oil prices stay this low. So that shows you how bad things are in the oil market and how it affects the oil nation.
And I suspect that might continue. You know, this is the third time in my life that oil prices have fallen by 60% or more. And as I said at the beginning of this interview, the process of supply destruction is very messy. The truth is that the oil industry and many oil producing countries became very overcapitalized during the oil bull market from 2002 to 2012. Supply destruction involves the cannibalization of capital. And overcapitalized institutions, whether or not they're oil companies or oil-based countries, takes a very long time. We saw in the decade of the 70s, as an example, with the gas bubble in the United States, that the industry was able to produce some gas at a discount to production cost, total production cost, for 5 or 6 years. The truth is that much of the total expense of producing oil and gas is front-end loaded in terms of the capital cost associated with acquiring the leases, doing the seismic, doing the drilling, putting in place the infrastructure. And the lifting costs are a fraction of total cost. The producer, having already paid the capital cost, will produce the asset down to cash lifting costs and sometimes lower than cash lifting costs as long as their balance sheets can bear it. And my suspicion is that that process could take as long as 2 years. I'm not saying it will take as long as 2 years, but it could easily take as long as 2 years. The interesting thing about supply destruction, though, Mo, is that when you come out the backside of it, the price recovery is dramatic because the industry doesn't have the ability to increase production rapidly to take advantage of rising prices. That's why in the last oil bull market, at the beginning of the last decade, the oil price ran from a low of about $15 a barrel to a high of about $120 a barrel. At this oil price, $35, make no mistake, you shut in most Mexican production. You shut in most Venezuelan production. You shut in most U.S. stripper production. You ultimately shut in the Canadian oil sands and you shut in the North Sea. That's simply unsustainable. Nobody believes that all of that is going to be shut in. But if the oil price stays this low for 2 years, the amount of shut-ins that you're going to see is going to be very, very dramatic. And hence the price recovery would be equally dramatic.
I agree with you. We're starting to see the effect it's having on a lot of the oil companies in the private sector. And I look at the big oil companies, they're focusing on strengthening their balance sheet by selling off assets to pay off their debt. A lot of them halted their dividend, especially the MLPs like Kinder Morgan has announced that they're going to stop their dividend. And we're looking at Chevron and Exxon and Royal Dutch. They're focusing on cutting their capital expenditure down by double digit. I think Chevron is going to focus on cutting down their expenditure by 25% in 2016. So a lot of focus is on trying to cut down expense and not much focus on increasing production because of the low oil prices. And most companies can't make money on $35 oil.
You're precisely right, Mo. The truth is what happens when you shut down or reduce sustaining capital investments is that you cannibalize your asset base. The truth is that oil and gas production is a depleting asset. You can't stand on the top of an oil well and throw down some fertilizer and some water and hope that the field gets bigger through organic growth. That's not the way it works. And the shortfalls that ultimately result from sustaining capital deficiencies are very grievous. The truth is that the sustaining capital deficits become cumulative and compounding, so that the damage that's done by not maintaining fields, not making the sustaining capital investments, takes many years and much more money to cure. The truth is, and it's a very messy process for everybody, consumers, investors, governments, but the cure for low prices is low prices, and the cure for high prices are high prices. And we will see that work out in the market in a very messy fashion over the next few years.
And so for the little guys on Main Street that want to invest in the oil market, is this the right time to get in and take advantage of the discounted prices in the market, especially for the MLP, the big oil stocks, and even the mid-cap stocks?
I suspect for the infrastructure-related MLPs, not all the MLPs, not the upstream MLPs, but for the pipelines, the gathering systems, the processing plants, the terminals, this is probably a good time. Maybe take half a position now and half a position mid-year. I think that people make a mistake selling off the midstream MLPs, believing that the oil price is the most important determinant in their profits, and it's not. Volumes are the most important determinants. Those companies have fallen very far in price, and I suspect that they're probably relatively attractive, particularly if, like me, you plan on buying them and holding them for the 10 or 15-year time frame. In other words, taking the distributable income out of them. With regards to the upstream companies, particularly the mid caps and the small caps, I would strongly advise waiting till the second or third quarter of 2016. The reason for that is that the company's annual reports, which will probably come out in April, will cause the companies to file an annual third-party evaluation of the net present value of their reserves. And those reserves valuations are what determines their borrowing base. Most of these companies utilize a credit facility called a revolving credit facility or an evergreen credit facility. This is an interest-only facility that provides more capital automatically as long as the ratio between the loan and the value of the proved developed reserves continues to rise. That's the difficulty. With lower oil prices, the net present value of the proved developed reserves falls, and hence these loans either get called or they begin to term. When that happens, this is the senior secured facility. And every facility that's junior to that, including all of the junk bonds issued by small and mid-cap Canadian and U.S. companies over the last 5 years, really gets called into question. And I suspect there's going to be an absolute bloodbath in the second and third quarter of next year in the junk bond markets. And if it happens to the junk bond markets, it'll happen to the equity markets too, because every single piece of debt, no matter how junky, is better than any individual piece of equity on any individual balance sheet. So I suspect a real bloodletting in the junior and intermediate oils in the second and third quarter of 2016. I suspect that both oil and gas will become parenthetically four-letter words. And when the hate is at its most extreme, the values are at their best.
Yeah, a lot of people on Wall Street were very aggressive in selling the junk bond for the oil companies, mainly because a lot of investors are starving for yield, so they look in that direction. So I agree, there's going to be a big bloodbath in that sector for this upcoming year. So I want to shift gears here and talk about the precious metals market. Now, the precious metal has not had a good year in 2015, obviously. For the gold market, it was down about 9.62%, and the silver prices, they were down 11.86% for the year. So I want to get your thought. Do you think the collapse in the oil prices had helped the gold and silver miners a little bit in reducing the input costs and kicking the can down the road in terms of bankruptcy?
Well, I do think that two things have helped non-U.S. gold producers. One has been the strong U.S. dollar relative to other currencies. So as an example, if you're a South African producer or a Russian producer, with your costs denominated in rand or rubles, respectively, your operating costs fell by half. On top of that, where the energy prices fell by half in U.S. dollar terms, and where energy is an extremely important part of the cost picture with regards to miners, the declining energy prices are very, very good for the operating mining companies. In terms of perception, the decline in oil prices lowers the perception that there's inflation in the economy, and in some fashion lowers probably the psychological appreciation for precious metals as inflation hedges. So it's probably a double-edged sword, but on balance, certainly a positive for the mining companies.
And that's a great point. Now, overall for the precious metals market, it's in bad shape. I think we're at the tipping point for a lot of the majority of the surviving gold and silver miners, where that if something that doesn't happen in 2016, we're going to continue to see a lot more bankruptcy in the pipeline.
Well, for me, that's a good thing. I think that the mining industry needs a Darwinian thinning. I think for 40 years, the mining business has been substantially overcapitalized, and the management teams, by and large, have been characterized by bad rather than good managers. And I would see an ongoing wave of bankruptcy as an extraordinarily good thing from all points of view. One example would be in the junior mining sector, where there are alleged to be 600 companies on the TSXV that can afford to make no substantial project expenditures because they have a negative working capital. We refer to these companies as the cockroaches. The cockroaches cost sort of minimally $300,000 a year to keep alive, but the best estimate of the G&A required for an operating company that's public is about $1 million a year. If each of these 600 companies were viable and spending $1 million a year, $600 million in general and administrative expense would be torn out of the exploration community for the care and feeding of cockroaches. The truth is that the bankruptcies that you talk about are what the mining industry needs most to ultimately thrive. Now, back to the first part of your point of view, which had to do with the commodity prices for gold and silver. If you've been in the business for 40 years like I have, a 10% decline in precious metals prices is absolutely a non-event. And for me, what happened in terms of precious metals markets in 2015 was a sort of a sideshow. In fact, for me personally, because I'm a consistent buyer of precious metals, or at least the precious metal surrogates, like the Sprott Physical Gold, Sprott Physical Platinum, and Sprott Physical Silver Trusts, the declines between 9 and 11% were a blessing to me, given that I'm a consumer of gold and silver. The fact that I was able to buy it in a less expensive fashion was, in fact, a blessing to me. The other thing to point out, Mo, is that if you held precious metals in any currency other than the U.S. dollar, they perform fairly well for you. As an example, if you lived in Russia or South Africa and held precious metals, the truth is that your precious metals performed extremely well in your own host currency. It's only those of us who live in the land of the free and the home of the brave, who denominate our wealth in U.S. dollar terms, that felt that precious metals underperformed.
Now, why do you think that is? Why do you think the gold and silver price in U.S. dollar has not caught up with the other currencies?
Well, the U.S. dollar has been extremely strong, and I think for all of the evident faults with regards to the U.S. society, the U.S. government, and the U.S. economy, as Doug Casey famously says, we're the prettiest mare at the slaughterhouse. Doug famously says that the dollar is an I owe you nothing, while the euro is a who owes you nothing. And the truth is that it's the weakness in all of the competing currencies, I think, that makes the dollar appear strong. Now, some of the strength in the U.S. dollar and U.S. dollar-related instruments, as an example, the U.S. Treasuries, completely confound me. I personally believe that the real yield on the U.S. 10-year Treasury is negative. Jim Grant famously characterized that instrument as return-free risk, which doesn't feel attractive to me. But the truth is I've believed this for a couple of years, which is to say I've been wrong and the market, at least in the near term, has been right. That is to say, I believe that the dollar strength is relative strength. I'm not sure it's absolute strength, but the market believes very differently.
Now, another major event that happened in 2015 regarding, well, I guess it's the commodity market is what's going on with Glencore, which a lot of people predict is the next Lehman Brothers, which end up in bankruptcy. A lot of people are thinking that Glencore is going to collapse due to their over leveraged balance sheet and their exposure to the copper market, which collapsed in 2015 again. I want to get your thoughts on Glencore.
The people behind Glencore are extremely bright people, extremely good financial engineers, and have excellent access to credit. Uh, when you look at the aggregate leverage on their balance sheet, you have to understand that an awful lot of that is trade credit. Financing inventories where there is ultimately a taker on the hook. My suspicion is that the damage to Glencore is severe but survivable, particularly because many of the on-balance sheet liabilities are ring-fenced around assets or around inventories. I do believe that Glencore is going to have to make some deals with regards to some of their assets, and it will be weakened. And I believe that some of their cash flows will be constrained because I think their access to credit to finance the trade inventories will become problematic. But I personally believe Glencore survives. I don't believe it enough to be a shareholder, by the way, but I do believe they survive.
Right. Now, do you think that the merger and acquisition activity will spike up in 2016 for the precious metals market due to the fact that a lot of these miners are not able to survive a more prolonged period of low gold and silver prices?
We're just starting to see an increase in M&A activity, real M&A activity, and that's critical that we have it. The larger companies have more liquidity and better access to capital. The industry needs more assets under fewer management teams, which is a different way of saying the general and administrative expense relative to total revenues and book assets needs to go down. The other thing is that putting more assets under one management team allows for a more efficient decision-making process in terms of capital expenditure among assets. So all of these are a good thing. I was struck when I was at the Mines and Money conference in London in December by the incredible uptake I got when I, in my speech, said that institutional investors like ourselves owed it to our clients to begin to force amalgamation as opposed to be passive participants. And the amount of institutional investors who came up to me afterwards saying that they agreed 100% that the institutional investors had to become proactive in forcing amalgamation was very heartening to me. And I think that you will begin to see that process occur more dramatically in 2016, and I think that's a very, very good sign.
Before you go, I want to get your outlook for 2016, and let's continue to talk about the precious metals market. Now, you don't have to give me a price prediction or anything, but I just want to get your insight on what's going to happen in the precious metals market for the next 12 months.
I think 2016 is going to be extremely messy. I believe, but I believed it in 2014 and 2015 too, and was wrong, that the better issuers are going to have to come to market in 2016 and raise capital under terms that are reflective of current market conditions. I also believe that the institutional investors are going to have to begin to act rationally in 2016, which will mean some fairly aggressive selling of names that are behaving badly. I believe that increasing focus will be paid by institutional investors on balance sheet and income statement items, particularly on the fact that many mining companies who are reporting lower unit costs and lower all-in sustaining costs are doing it via high grading, which is to say their mine grades substantially exceed the median head grade that they're using for their reserve calculations. What that does is it guts the deposit, taking out the best parts first, and it raises substantially the all-in sustaining cost that the companies enjoy in future years. And I think focus needs to be and will be on this in 2016. All of that means that I think the markets will continue to be messy and perhaps chaotic in 2016. But I believe if you view 2016 from the prism of 2020 or 2021, the 2016 will be viewed as the good old days in the sense that the prices that we're able to buy good assets for in 2016 will seem fictionally cheap by 2020 or 2021.
I want to get your thoughts also on the economy in general. The stock market for 2015 was pretty flat. S&P was 0.8% for the year. NASDAQ was up, actually, 7.59%, but the Dow was down 0.66%. What is your thoughts on the economy and the stock market going forward in 2016 now that the Fed have raised the rate by 25 basis points?
I think the 25 basis point raise was built into the market, frankly. And it would appear in the very near term to be sustainable. What will be interesting with regards to the interest rate is whether they continue to raise it. If they can continue to raise it and make it stick without impacting, as an example, home sales, which are really a function of affordability, which is itself a function of the interest rate on long-term mortgages. And if they can continue new car sales, which is also a function of finance costs, and make these interest rate rises stick, then at least the tepid economic growth that we're enjoying in the United States can continue. If they aren't able to do that and the interest rate rise has to be rolled back, in other words, if the economy can't sustain at least a couple more 25 basis point rises, then I think all bets are off. I think you see the U.S. dollar decline, and I think you see the gold price do very well. I'm not suggesting which I think is going to happen, by the way. I'm encouraged, I think, by the strength in both the balance sheet and the earnings of the S&P 500 companies. I'm not a general market analyst, but I'm reasonably good at balance sheets, and I'm reasonably good at income statements. I'm impressed by the profit margins. I'm impressed by free cash generation. I'm particularly impressed by the fact that when you look back to the early part of the last decade, American multinational companies were engaged in hiding debt in offshore subsidiaries. In other words, they wanted the balance sheets to seem less leveraged than they were. The chief financial officers of those companies got religion in the fiscal crisis of 2008. And what you see now is American multinational companies hiding cash offshore. The truth is that the balance sheets these days are much better than the balance sheets were 12 years ago. And I'm impressed with that. I'm also impressed with the fact that these companies are able to generate enough free cash that they can distribute some of it back to shareholders via dividends and via share buybacks. Now, a lot of that is a function of very low interest rates and very low cost of capital. I don't know how long it can continue, but the truth is I'm probably less antagonized by U.S. equity markets than I am by the apparent lack of strength in the U.S. economy below the S&P 500.
Now, one more question before we let you go. I want to get your thoughts on the uranium market. I know you have an interest in that market. I want to get your thoughts on what do you think is going to happen in that market in 2016?
To paraphrase the great country singer Patsy Cline, I was so wrong. I had anticipated a faster rebound in global demand for manufactured goods from Asia. And the consequence of that is that I had anticipated that the Japanese nuclear fleet would have to restart earlier than it has. The truth is that an increase in the uranium price is inevitable, but I'm no longer quite so sure it's imminent. No less an authority than Cameco, the world's largest uranium company, suggests that around the world, the industry median cost of production, including the cost of capital, is about 65 US dollars per pound. So the economic proposition right now is that you make something for $65 and you sell it for $38, and you try and make it up on volume, losing $20 a pound. This is cannibalization of capital at its absolute finest. Now, the truth is that we have a whole bunch of uranium in inventory. So the question doesn't get called for a couple of years. I can't tell you precisely when the question does get called, but the question does get called because every year uranium demand increases, and we suspect it will increase more rapidly in the future given the pace of nuclear power plant construction, particularly in Asia. But the truth is, I would have suspected that it would have taken place in 2015, and I was certainly wrong.
So, Rick, before I let you go, please tell our audience where can they go to find your products and services.
Well, if this has been of use to your readers and listeners, I would encourage them to go to our website, www.sprottglobal. I would encourage them to hit the contact button. By doing that, you will subscribe to Sprott's Thoughts, which is a weekly presentation of the best ideas and information from the Sprott Group. I absolutely guarantee that your listeners will get their money's worth because it's absolutely free. If people would like to email me directly and ask me questions, they may do so. I'm reachable at RRULE, that's RRULE, at SprottGlobal.com, or you can call us at 800-477-7853.
Okay, Rick, well, thank you for your time. Do you have any New Year resolution you want to share with us?
They're personal, Mo. Some of it at age 62, of course, has to do with continuing my quest to become healthier physically.
Right, yeah, mine too, so it's all good.
It is good.
Well, Rick, thank you for your time.
Always a pleasure. Thank you.